To many of us, property investment can sound like it's reserved for millionaires who can afford to buy up enormous amounts of real estate. But investing in property can be done at much smaller levels than you think. That means you can start building your own mini empire pretty much straight away. Hi, I'm PJ from Rift, and in this video, we'll help you understand the different routes of property investment. We're going to weigh up the pros and the cons of each method and tailor your investment strategy to your own circumstances. Here's how you do it. Buy-to-let is probably the most traditional route into property investment. You buy a secondary property, rent it out to tenants over a long period of time, and use the rent to pay the mortgage or recoup the cost of the property. Unless you're already sitting on a chunk of money to buy the property outright, you'll need to take out a specific buy-to-let mortgage. They're not the same as your standard residential mortgage in a couple of ways. Firstly, the minimum 5% deposit for a residential property typically rises to 25% for a buy-to-let. Monthly payments are also often higher, so you'll need to crunch your numbers to make sure it's affordable. With the stamp duty holiday now over in the UK, you'll need to pay this on top of your initial deposit. That will be somewhere between 3% and 15% of the property value. Once you've got your property, you'll officially have the status of landlord. This comes with legal obligations like ensuring a safe environment to your tenants. If you prefer a hands-off approach, you can hire a property manager for an additional cost. If you consider yourself handy with DIY, now's the best time to polish up on your skills, as you'll need to factor in maintenance costs. Due to government measures, buy-to-lets are typically less profitable than they were in the past. Although the first £1,000 of your property's rent is tax-free, higher and additional tax rate payers feel the pinch the most when it comes to profit. Previously, landlords could deduct mortgage interest payments from their rental income. Today's landlords can only take advantage of a 20% tax credit on their interest. This means if you currently pay 40% or 45% tax on some of your salary, you'll need to be paying more for your property's income. It is possible to set up a limited company to include these mortgage interest payments. However, if you're new to property investment, it's a good idea to seek professional advice on this. Acting as the halfway house to renovation, pre-renovating is all about putting in the hard labour for potential buyers. Imagine a family has just inherited a fully furnished house that hasn't been looked after and is in need of full decoration. They list this property under market value at £130,000, with average house prices in the same area valued at £160,000. After stripping the property to its bare bones and tidying up the garden, you can now sell the property for £140,000 thanks to a bit of elbow grease. Unlike a full renovation, your aim isn't to transform the entire house. Instead, the method is to buy a property that's looking worse for wear and tidying it up with some simple cosmetics. You then sell it on again for a quick profit to renovators or movers looking for a DIY project. The main challenge with this method is it takes a particular type of house in order to reap the profits. You must be able to identify the fine line between an unpolished gem and a house that's barely worth its bricks. Knowing the area will help you gauge your profit margin once the work's done. Doing your research before purchase can help reduce this risk. Stamp duty and solicitor's fees are often factors to think about, as they can also eat into your profit. Calculating these beforehand will put you in good stead before getting your hands dirty. The best case scenario is to line up a buyer so that you can avoid estate agent fees and ensure a speedy completion. Compared to pre-renovating, renovating is when larger scale works are done to improve the appeal of a home. This can be quite pricey and requires a bit of property know-how to get the best returns. As well as buying the house itself, you'll need budget to renovate certain aspects that will bring it to the top of a buyer's wish list. If you're in need of some motivation, Hampton's estate agents found out that renovators made £48,190 on average per home during the pandemic. When looking for a property, popping into an auction may be your best bet if estate agents aren't quite cutting it. Although there will be bargains, be mindful of bidding wars. Thinking in the eyes of the buyer will pay dividends when you come to selling the property. Follow Kirsty and Phil's advice of location, location, location. Even the best renovations won't necessarily attract buyers to an undesirable part of town. By keeping your friends close and tradesmen closer, you can lower labour and material costs that often turn out to be more than expected. Picking where to put your money is a big part of the job. Statement pieces like a new kitchen can add somewhere between £20,000 to £30,000 to a house's value. Loft conversions rack up even more profit, adding up to £100,000 if you manage to fit a bedroom and ensuite in there. The foundation of any good renovation is to buy ahead of the curve in an up-and-coming location. As a general rule, you don't want to spend any more than 70% of the renovated asking price after costs are deducted. This way, you'll make the budget work harder and ensure a tasty chunk of profit at the end. A real estate investment trust, or REIT, is when you put money into shares of a company that invests in property. Although you won't own the property itself, you will own a stake of the company that does. That allows you to make income without the substantial startup costs. But before we get into the pros and cons of REITs, make sure you hit the subscribe button below. That way, you can stay up to date with the best ways to make your money go further, because you're always better off with Rift. So, back to REITs. They are required by law to pay at least 90% of their income each year as dividends, and the profit levels of the trust will determine how much money you receive. So the more you invest into an REIT, the greater your dividends will be. As with all stocks, the price can fluctuate over time. Although property isn't seen as high risk as other markets, it's important to understand your investment can still fall or rise in value. To get started with REITs, all you need to do is invest through an ISA or SIPP, since REIT companies are listed on the London Stock Exchange. Similar to REITs, property crowdfunding is when investors get together to put money into property. But instead of buying shares of a company, you're actually buying a small share in a property. What makes this attractive is you can kickstart your property investment journey for a fraction of the cost compared with buy-to-let. As there are different types of property crowdfunding, we'll stick with the most common form. Through a crowdfunding platform, you invest anywhere from £100 to £1,000 into a property. You then earn money through the property being let to tenants, with the rent being divided up according to each investor's share. As you'll technically be in the business of renting out property, your risks are the same as a landlord, only on a much smaller scale. Your property's value may fall, or there may be times when your property sits vacant, meaning no income at all. Performance is very hard to predict, even though crowdfunding platforms will estimate your return. Depending on the platform, you'll either be paid monthly, quarterly, or annually, so it might not be best for those looking for a regular, reliable income. It's worth keeping an eye out for platform management and managing agent fees, who will take a percentage of the total income. You may find cheaper rates on some platforms, but be careful to limit your risk if they don't have a solid history or good reputation. As with most things in life, choosing the best route for you comes down to your personal circumstances and tolerance for risk. Investing in small amounts will rarely produce life-changing sums of money. If you've got some money in the bank and are handy with the tools, you might choose to go for it full throttle. Others might choose to dip their toe in the shallow end just to get the journey started. The important thing is to arm yourself with enough knowledge to make the right decision. You can subscribe to the Rift YouTube channel to stay up to date, and also check out the Rift refund guides link below. Thanks for watching.